Saving money shouldn't feel like a punishment. What if a single habit could turn small choices into real wealth over time, right here in North America? Today's plan is practical and doable. A 30-day zero-based budget with automatic savings and a straightforward investing habit. It isn't about deprivation. It's about giving your money a clear job and letting compound growth do the heavy lifting with minimal drama. You'll see how simple shifts in how you handle money can add up to meaningful results over a few months. The core idea is simple. Assign every dollar a purpose before the month begins, so you're not reacting to every impulse as it comes up. With that level of clarity comes real control, and with control comes less stress, more progress, and a clearer path to what you want long-term. We'll tailor the approach for both US and Canadian systems, so you don't have to guess what actually works. Step 1 is to set up a zero-based budget that you actually follow, not one you file away in a drawer. That means by the end of each month, every dollar has a job: rent or mortgage, utilities, groceries, debt payments, savings, and investing. If money is unassigned, you tighten the plan until nothing is left unassigned, even if that means delaying a small discretionary expense. Step 2 is to track spending for 30 days with honesty and humility. Use a simple tool you know you'll actually use, like a clean spreadsheet or a lightweight budgeting app that doesn't bombard you with reminders. The goal isn't shame, it's awareness, so you can adjust with intention. Step 3 is to automate savings, so your future self gets paid first, every single month. Set up automatic transfers the moment you get paid, a fixed amount to a savings account and another to your investment fund. Start small, maybe 5 to 8% of take-home pay, and raise it as you adjust lifestyle or income. Step 4 is to use tax-advantaged accounts for investing, because taxes shouldn't steal your gains. In the US, contribute enough to get any employer match in a 401k, and consider a Roth IRA for tax-free growth over time. In Canada, use a TFSA for flexible tax-free growth and an RRSP for a bigger tax break on your return when you're ready. Step 5 is to choose a simple, low-cost investment mix that you can stick with for years. A common, sensible option is a broad index fund that tracks the total stock market, paired with a smaller allocation to bonds if you want balance. Automate your monthly contribution to that fund as part of your budget so you never miss it, even when life gets busy. Step 6 is building and maintaining an emergency fund that actually does its job. Start with a starter target like $1,000 to cover small surprises, then push toward 3 to 6 months of essentials as your budget allows. This cushion keeps you from turning to high-interest debt when a car repair or medical bill lands. Let's walk through a concrete example so the plan feels real. Take-home pay is $3,500 after taxes, and you decide on a disciplined distribution to make progress. You assign $350 to savings and investing, $1,900 to fixed costs, $700 to groceries, $300 to transport, and $250 to discretionary spending and occasional buffer. That $350 goes directly into your chosen index fund, preferably through payroll if your employer allows it. If you're in the US, top up the 401k to capture the employer match first, then fund a Roth IRA for tax-free growth later. If you're in Canada, direct the amount into a TFSA or RRSP in the correct order based on your current tax situation. Frugality in this system is practical rather than punitive. It's about reducing obvious waste while still letting yourself enjoy real-life moments and small rewards. Common wins come from meal planning, cooking at home, buying used when sensible, and canceling subscriptions you forgot you had. Meal planning prevents impulse buys and lowers waste by organizing what you'll eat this week. Batch cooking saves time and energy and reduces the cost per meal. Buying used furniture, tools, or clothes can dramatically cut expenses without sacrificing reliability. Think of every saved dollar as a tiny seed you plant in your financial garden. When you automate saving, that seed grows into a tree of wealth through compounding and steady contributions. Over months and years, disciplined planting compounds into real financial security. Avoid lifestyle creep by keeping the base budget stable even as income grows. If you cut a big expense but spend the extra elsewhere, you won't gain traction. Be mindful of high-interest debt and focus on paying it off as a priority. Create a weekly ritual to review and adjust. Set a recurring 15-minute block on Sundays to compare plan to reality, celebrate small wins, and fix what isn't working. If something isn't clicking, tweak the numbers rather than ditching the plan. Automation isn't magic. It's discipline without the daily struggle. When money moves automatically, You don't rely on willpower to save and invest. You rely on a system. Your future self will notice the difference in a few short months. Choose tools that fit your life, not vice versa. A simple spreadsheet can track every dollar, and free budgeting apps can handle the basics if you want them. Avoid paying for features you won't consistently use, because consistency beats sophistication. Now it's time to act with intent. Set up your budget template, connect your accounts where possible, and automate at least one saving and one investing transfer. Tell me in the comments which step you'll start with and why you chose it. If this helped, like the video, subscribe for more practical money tips, and drop a comment with your first step. See you in the next video.